Hey guys, Dave Keller here with Market Misbehavior. I love to ask interviewees what their one chart would be. And that is, if you had one chart, just one chart, besides a regular chart of the S&P 500, as a way to understand the broad market environment, what would it be right now and why? So here is my one chart for today. Okay, so today's chart is what I call New Dow Theory. Now, if you're familiar with Dow Theory, that's the concept that Charles Dow created in the early 20th century, basically looking at two main parts of the economy and whether or not they were in agreement about the direction of things. And so you would look at the Dow Industrials versus the Dow Transports and see how they were moving. And at the time, it wasn't the transports, it was the railroad index. So the industrials would be the producers of goods and the railroads would be the distributors of goods. And the idea is if the producers and the distributors both doing well, then the economy is good, the market is good. If one of them is not doing well, it shows an imbalance of sorts that usually means there's some underlying weakness that hasn't become reflected in the overall price. The problem is the Dow Industrials now includes things like big banks and service companies, technology companies. The Dow Transports isn't just railroads. It's things like airlines and other things really don't have to do with very much with distributing goods. So that general concept, while I still follow it, is kind of broken in terms of being a reflection of what Charles Dow actually was looking for. So what I follow is actually what I call the New Dow Theory, which is basically breaking the economy into two parts, the S&P 500 in the top panel, the Nasdaq Composite Index in the bottom. So what this does is reflects that the markets now are not driven by big industrial conglomerates and transportation that distributing their goods. It's the traditional market, the old economy and the new economy, right? The old economy represented by the S&P 500, including financials, consumer stocks, and all of that, as well as industrials, basic materials, and so forth. And the Nasdaq Composite really focuses on the technology side and embraces the fact that technology has a pretty significant central role in the functioning of our modern economy. So the general idea is this. If these two indexes are both making higher highs, both breaking above resistance, overall the conclusion is positive. If they are both breaking to new lows like they did here in February to March, both breaking to a new swing low, that suggests confirmation of downside as both are confirming a breakdown of previous support. When one of them does not confirm the other, you call that a non-confirmation. That is why this is this is my chart right now. Basically, the Nasdaq Composite, as we know, has already broken above its February high. It's continued to make a pattern of higher highs and higher lows. And even though this week you've seen a pullback in sort of the mega cap tech trade, the FANG trade or the FANG man trade or the MAGA trade or whatever you call it, most of those names have sort of reverted to the downside just a little bit. But overall, the long-term trend out of the March lows has remained very positive. If you look at the S&P 500, overall, the trend has remained positive. But while the Nasdaq Composite has already broken above its high from the second week in June, the S&P 500 has not quite done that yet. So on a closing basis, it's bumping up against that close from the first week or two of June, which is around 3230 or so, 3240. So my conclusion is this: if the S&P 500 is able to break above 3250, which would put it above the June highs, as the Nasdaq Composite remains in an uptrend overall, that suggests further upside. That suggests to me the S&P should retest 3,400, if not even further, and overall the trend is very positive. If, however, the S&P fails here and pulls back in a meaningful way, what that tells you is there's a non-confirmation with the technology-heavy Nasdaq Composite moving higher, but the traditional companies, the S&P 500, unable to eclipse that previous high. So this is my one chart for today because it illustrates a potential non-confirmation in what I call New Dow Theory, the S&P 500 versus the Nasdaq Composite, the old economy versus the new economy. And I'm looking to see if the S&P is able to eclipse its previous high and break above 3250, which would suggest potential for further upside. For Market Misbehavior, this is Dave Keller. Have a great night.